G'day listeners and welcome to another APS Weekly News Bulletin, keeping you up to date and well informed on the Australian property market in real time. Now today guys, I've got a very special guest. He's down from the north. He's not up from the south like Big Jimmy. He's down from the north, Mr. Lukey Chusa, mate, from Northern Brizzy. How are you, buddy? Welcome to the studio. Welcome to an APS Weekly News Bulletin.
First one of these ones.
First one.
A little bit different to our normal potties, but keen to be here, keen to unpack some topics that we see in the news. Always a lot of content out there that's good and bad, so we'll see how we go.
I'm looking forward to dissecting a couple of these things for you, mate. Now we like to keep them short and punchy, so mate, let's jump straight into it. Story number one. 4 rate cuts predicted in the next 12 months. Experts predict. Big Lukey. Article by Aidan Devine from news.com.au. An expected barrage of interest rate cuts next year could reignite another nationwide property boom, experts claim. ASX's RBA target rate tracker, published at the end of each trading day, revealed that Australian financial markets have begun pricing in 4 interest rate cuts within the next 12 months. The RBA is expected to first cut interest rates by 25 basis points in February, with 3 more by August. According to the market expectations. It's the first prediction of multiple cuts since the Reserve Bank started hiking rates in May 2022. The cuts have been predicted on forecast drops in US interest rates, which would raise the value of the Aussie dollar relative to the greenback and put the RBA in a better position to drop the rate. 4 interest rate cuts would bring much needed relief to existing homeowners and prevent many families from needing to sell their properties. But first home buyers are being warned that the cuts could do as much harm as good by increasing competition for housing and pushing prices up. Few extra points here, Lukey. SQM Research Director Louis Christopher said that 4 cuts next year, while still a remote possibility, will cause a huge rebound in property markets that have recently been weaker. The RBA's official cash rate sits at 4.35%. The current owner-occupier variable discount rate sits around 7%. It comes as several lenders cut fixed and variable home loan rates for both owner-occupiers and investors in early September. An expert said cuts to fixed rates are often an indication the bank's expected variable rates to be lower in the coming months. My housing market economist Dr. Andrew Wilson said homeowners should take the ASX predictions with a grain of salt. It comes from a speculatory environment and a lot can change between now and then. Lukey, what are your thoughts, mate? 4 potential rate cuts in the next 12 months, mate. It's a pretty big call.
I think what was really key there is right at the end, they were very keen to say it's a very speculatory environment. Yes. So no one necessarily knows exactly when they will cut rates. You know, we've had a crack at looking at it in the past and making our predictions, which we've been wrong. I'm happy to admit that. But I think inflation's been a lot stickier than a lot of people expected. So we're definitely seeing an environment where no one necessarily knows. We are seeing a lot of our brokers that we work with hand in hand telling us, the 2 and 3 year fixed rates are coming down.
Yeah. And they're coming down to pretty decent rates, man. We're seeing some stuff in the mid-5s, which is ridiculously low for where we've been for the last couple of years. But it's a really good indicator to see the fixed rates at 2 or 3 years coming down to that amount. It means that the banks are expecting to still make money on a variable rate coming in below that, right, over the next 2 years as well. Yeah. So it's very interesting to see happening.
And the other day when Kaz's podcast released, he was talking about on there, he's saying, are you smarter than the economists and the analysts that are setting these fixed rates?
Yep.
So if they're very much seeing that rates are going that way, I don't see them getting it wrong again. They got it pretty wrong in COVID where they fixed for 2, 3, 5 years at less than 2%. I think they're reeling from that and they're being a little bit more conservative, but no one exactly knows when. But when you start to see those 2 and 3 year fixed rates come down, it's a pretty good sign that they're expecting it to be below where that is. Otherwise, they would be losing money.
Yeah, I think it's a pretty good indicator that, over the next 2 years, they're definitely forecasting a fairly substantial rate cut to be coming through. And that's over the 2 years, right? So if it's 2 year fixed rate, they're probably expecting the variable rates to be coming in under that, within that time frame, and probably realistically within the next 12 to 18 months, and then potentially falling even further as well. So I think that's going to be really interesting to watch. But again, man, it's exactly as Andrew Wilson says there as well, in terms of you really need to be having a look at this thing from you have to take it from a pinch of salt perspective, because it all comes down to inflation, and like, there's a lot of other economies out there, a lot of other countries out there that are cutting rates at the moment, but ultimately that's not our economy. The world economy, yes, it is what it is, and we obviously have flow on from a few of those, but ultimately the Australian economy and our inflation target, we need to get that back into the target band.
Independent. Yep.
Yeah, man. And so like until we do that, it's not gonna happen in terms of a rate cut. So I think that's the most important thing to probably watch. And a lot of people are pricing in and looking at rate cuts starting from February. The RBA really bullishly came out at the last one, like very openly, very stolidly said that there aren't going to be any rate cuts this year and potentially next year when inflation comes back within the target band. So we've got 2 more, significant quarters that they're going to be called before then. You've obviously got I think it's the end of September one one, and then the end of like the December one as well, where we're going to see what those numbers come out at too from the inflationary perspective. But realistically, we're not gonna see that until early in the new year, coming into February. So it's going to be very interesting to kind of watch that, come through, play out, see what those numbers are. Yeah, man, that's really going to be what affects interest rates, in my opinion, man. It's not till we see that fall in there, or are they going to start even considering it?
The hardest part is that December quarter that will get released in January, February, when we see it in the new year, includes Christmas.
Yeah.
So it's very much a high spending environment that we usually see an increase.
But we saw that
as well.
last year, and last year it still dropped 1.1% over that time frame. That's what I think made you so bullish on your comments when you came out and made your predictions and your bet, which you have not yet paid to date. But I think, man, it's one of those things, is like when you're still in a tighter environment, we're seeing it a lot now where people aren't spending, so openly as they once were, going out, and spending so much out there in the economy too. So if there is a bit more financial pressure, which obviously there is from the higher interest rates and from a slowing economy, man, it'll be interesting to watch. But yes, there will be more spending during that holiday period. But I think if last year was anything to go by, we've had another year of high interest rates set in and put the pinch on a lot of families. Man, I personally don't think, I don't think we're going to be seeing spikes. I think if anything, holding firm over that quarter, but it'd be good to see it coming in under, because obviously it's good for all our clients and ourselves as investors to see lower rates come through, both from a cash flow perspective, and it should put a bit of a burner under the market, as these boys are talking about as well.
Yeah, I think a lot of investors too, especially if you're in a position to continue to buy, they're not opposed to rates staying a little bit higher for a little bit longer, to give them some more time to acquire before everyone comes back in the market and has a bit more capacity behind them to start jumping in again. One thing as well, where you said before about other countries being different markets, America's back in its target range for inflation. So that's where everyone's comparing Australian economy to the American economy and saying, well, it's back in its target band, we should be back there surely too. Not necessarily. They're different economies and they're different sort of indicators as well, and what they track. So we definitely do track America to a degree, but again, it's a different economy. But just because they're back in theirs and they're going to start cutting at some point, doesn't mean we're just there. But it's sort of insight.
Yeah, man. And because I remember, I read an article, I can't remember where it was, and they're talking about, I think it was Japan, America, the EU, New Zealand, I think it was, they're all back within target band, and they were all saying but they're cutting interest rates. It's like, it's because they're back into target band of what they wanted from an inflationary perspective. So until we get back there, we're not going to do it. Man, I like what you said there as well, that point in terms of there's some investors that want it to prolong a little bit. I think this is a thing, man, of your advanced investors and your beginners. And obviously, depending how advanced you are and how much you rely on cash flows in your portfolio, it's one thing. But man, I think intelligent and advanced investors know that, when interest rates are a bit higher, there's not as much heat in the market because there aren't as many people out there willing to buy. There'll be more people sitting on the sidelines waiting for rates to come back. I think the intelligent investors, you and I both have been pretty aggressive this year. We have a lot of clients that we work with that have been aggressive this year and taking advantage. And that's what I would probably almost be more urging of, take advantage while the rates haven't been cut yet. This is when you want to be buying and acquiring, because when they start to go up, yes, your cash flows are going to increase, but that
so
demand,
is everyone else.
that demand for everyone else, from everyone else out there getting in as well, is obviously going to increase too.
Awesome.
But mate, let's leave it on that front. You've got point number 2, mate. Let's jump in. Story number 2.
So number 2 is interest rates weigh on NAB customers as arrears jump. So an article by Lucas Bard from the Australian Financial Review. So it's really going into what we were talking about previously. So I'll go through it. And so delinquent loans of National Australia Bank have jumped higher in the June quarter as the highest interest rates in a decade, and persistent inflation creates a challenging environment for borrowers. The lender said non-performing loans were 1.31%, up from 1.2% off its books of June 30. So reflecting continued broad-based deterioration in business and private banking, combined with higher arrears from the Australian mortgage portfolio. So Mr. Irvine, which is NAB's Chief Executive Officer, said the economic environment, including persistent inflationary pressures, is challenging for all customers. It is essential we keep our customers and our bank safe. So he basically went on to say that it wasn't unsurprising based on the inflation that we've seen and the cost of living that we've gone through, and then the interest rates as well. So they weren't overly surprised. I don't think it's a common thing that banks are seeing arrears rise. But this is basically to talk to how, cost of living and people are starting to default. So what I want to sort of unpack with you is, what are your thoughts in terms of, do you see interest rates actually starting to bite, and do you reckon that is reflected across the wider lending market, or is it just NAB for example.
Yeah, man. No, I think it's a great point. It's a cool thing to unpack as well because, like, ultimately, a lot of your first home buyers and probably beginner investors and stuff, they start with the big four banks. They start with your NABs, your Combanks, your Westpacs, or NZ, all the rest of sort of stuff, right? So they're starting with those bigger home loan companies, right, and banks. They're starting with the bigger banks, right, as they always do, because it's what they know, it's what the safest sort of thing. So if one of the biggest banks out there, which is the NAB, has got a delinquencies playbook of 1.3%, up from 1.2% over 12 months in the highest interest rate increases that we've seen in a long time. It's a very small amount, and even the fact of it's only gone up, whatever that is, it's not even it's 0.1%, but it's not even like 10% of that across the year. It's probably like 8%, right? So it's a very, very small amount. Sorry, and that's 8% of what it originally was, of 1.2 to that 1.31%. 0.11% of their entire loan book is next to nothing. And I think that's a really important thing to kind of have a look at from that perspective. Huge bank, a lot of first home buyers, a lot of probably early investors and whatnot that are kind of in there. And if they're in arrears, it's one of these things that's why the interest rates were jacked. The interest rates were jacked to bring some pain to the economy, to bring some pain to people out there. And it's not so much to bring pain, it's to slow things down. Because when you fall into arrears or when things happen or whenever that financial pressures come in, what do? You pull your purse strings in and you stop spending out there in the economy. How do you stop inflation? How do you stop things being driven up and all the rest of it from that perspective? You stop people being able to go out there and spend money on things. This doesn't surprise me in the least. I wouldn't be surprised if all the other big banks, if not all banks, were experiencing a 0.1% increase in their loan books of people in arrears. I actually thought it would have been higher than that. For a 12-month window, I'm really surprised it's not higher than that, considering the 12 months of peak interest rates of where we're at now, where a lot of people would have taken out their loans in the 2s and 3%. Even a lot of people fixing at the 1.99s, they've all come off, in the last 12 to 24 months. So I'm surprised there actually aren't more loans and more people struggling from that perspective. So yeah, man, for me, it's what I would expect to happen. And in reality, it's what the RBA really was hoping to happen to help slow down the market a bit.
I think as well, one of the points you make there is really key. 0.12% is not a small amount, but in terms of their entire client base, it is actually a number of people. And then, like you said, I wouldn't be surprised either if it was across the wider banking environment across all banks. But if you took that 0.12% from every single bank and added them together, I reckon the total number of people in arrears would actually be quite high in comparison to what it was potentially 12 months or 2 years ago. I
think the interesting comparison would actually be going back 10 years ago. So we're talking about 1.3% of one of the biggest banks in Australia. 1.3% are in arrears. You know what I mean? There's a lot of businesses out there that have more than one or two clients at a time that aren't paying their bills. You know what I mean? So to have 1.3%, I would be very interested to wind back to what are the numbers in the GFC? What were the numbers 15 years ago after the global financial crisis? How many people in arrears then at that time? Or even in the 2000s, 2010s? I'd love to know from that perspective because it's also coming from an extremely low base, right? Of where interest rates were super, super low and no one was in arrears to then be sitting at that amount. Yes, okay, sweet. There's a little blip. It's a little uptick, but in reality, man, it's in my mind, it's completely expected. It's the norm. It's also a tiny, tiny amount in in the greater scheme of things as well for a bank of that size.
Yeah, I think it just shows that the measures that they've taken to bring inflation under control are definitely starting to bite. You know, when you start to see these numbers roll through, it's a reflection of matters that happened 3, 6 months, 12 months ago. Yeah. It doesn't happen overnight because usually a bank will give you 3 months and then they help you pay it off, and there's all sorts of different policies, freeze periods and holiday periods. They all have those policies, so it's not an immediate flow-on effect. It generally takes 6 or 12 months to flow through, and we were talking about this over a year ago that we would expect this at some point. So.
It surprises me that over a 12-month window, it rates where they are. That actually surprises me how low it is. I thought it would have been a lot higher, a much bigger increase.
Yeah, I definitely think as well. But I think as well, the reason we're unpacking it as well is to really show that I think it is starting to bite, but I don't think it is biting as much as we expected it to, that's for sure.
No, definitely not. No, I'm with you, man. Any other points on that?
No, all good.
Beautiful, mate. Short and sharp, beautiful. Little APS Weekly News Bulletin. Listeners, I hope you took some great value out of it. If you did, to someone else who also might take some great value out of it. If you're enjoying Big Lukey Chewson being on the APS Weekly News Bulletin, write in, let me know. If you're not enjoying it, also let me know. I'll send them on to him and put the knife in. Lukey, mate, thanks for jumping on and joining us. Listeners, thank you once again for tuning in. Until next week, that's an APS Weekly News Bulletin on the Scouting Australia podcast.